Trading covered strangles is a popular strategy among traders that look to profit from the stock price movement while mitigating potential risks. In a covered strangle, we're going to short a call option and a put option on the same underlying security with different strike prices. And we call it covered because the trader actually owns the underlying security. So it's going to offset potential losses from the options positions. So the goal is to profit from the movement of the security's price within a specific range. So let's imagine that you bought 100 shares of XYZ Corporation and it cost you $50 a share. And at the same time, you short a call option with a strike price of 55 and you sold a put option with a strike of 45. So as long as that stock price remains within the range of $45 to $55, you can profit from the time value of the options and potentially could earn higher returns than just a covered call. If that stock price moves outside of the range, you can adjust your position to minimize your potential losses. So the benefits, you can profit from both up and down movements in the underlying stock. You can earn higher returns in a covered call strategy. You can mitigate potential losses because you own the underlying security. You can profit from a stock that's expected to remain within a specific price range. And you have the flexibility to adjust the strangle position to maximize your profits or minimize your losses. And what we want to happen, we want that stock price to remain within the range of those strike prices. If that stock price moves outside of this range, you can adjust your position. You may also want the stock price to move in either direction because this is going to allow you to profit from both up and down movements in the stock price. That's just not possible with a covered call strategy. And a covered call, it's different. A covered strangle, we sell a call option and a put option. A covered call just involves buying a call option. A covered strangle, you can profit from both up and down movements in the stock. A covered call only allows you to profit from upward movements. The strangle could earn potentially higher returns than a covered call if the underlying security's price remains within a specific range. A covered call only have a return if the stock goes up. Finally, get more flexibility to adjust your position, maximize your profits or minimize your losses. So again, you buy shares of the underlying security, you sell a call option, that's a bear position, and a put option, that's a bullish position on the shares, different strike prices. So if that stock remains within the range of those strikes, you can profit from the time value that's on the option. If it goes outside of this range, you can adjust your positions. You can also profit from both upward and downward movements in the stock prices. And again, you can't do that with a covered call. What's our max loss? Here's an example. Say we bought 100 shares of XYZ stock for $50 a share, cost us $5,000. You sold a 55 call for $3.50. Received a premium of $350. You sold a $45 put for $225 and received a premium of $225. So your max risk is the $5,000 for the shares minus the premium for the call minus the premium for the put, $44.25. However, we're also long a put, which means if the share price drops below the strike price of $45, you could be on the hook for the shares. $45 a share times 100 equals $4,500. So your potential loss could be upwards of $8,900. Max profit is actually limited to the total premiums that you received, plus upper strike price minus the stock price. So in our example, the maximum profit is $1,075 because the total premiums received are $5.75. The upper strike price minus the stock price is $5. That's the stock. We have to sell the stock to profit from that. So this is the max amount of profit we can earn if that stock price remains within the range of the strike prices and does not move outside this range. If it does, we could incur losses on the option position. Break-even prices, just take the stock purchase price minus the premium received for the strangle. So if you sold a call option with a strike of 50 for a premium of $2 and a put option with a strike price of 45 for a premium of $1, share price minus $3 would be your break-even price. So in summary, a covered strangle, it's a strategy for traders who are looking for a little bit riskier yet potentially more profitable opportunities than just a covered call. You do have the potential to earn higher returns if you correctly pick the stock and the strike prices, and at the same time you have the flexibility to adjust your position. So you can get the inside scoop on two of the most exciting markets that we trade. It's our one-day options trading strategy. It's a free PDF download. You get enter your trade today, exit tomorrow. You can download the free guide. Again, in the description is the link. I'll talk to you.